in those moments, I'm trying to calculate expected value. I'm saying, okay, what's the likelihood that I'm going to make $3 million? What's the likelihood that I'm going to lose $1 million? Because both are real possibilities. And a lot of people get scared about losing the $1 million, but they don't understand that the $3 million, how real that potential is.
All right, welcome back to How to Invest in Commercial Real Estate. This is episode 79.
Man.
And we're back talking about another cool investing topic. So before we get into that, it's a little bit in the weeds. It's a hairy one, so to speak. But before we get into that, there's been a lot of interesting things going on in the market. By interesting, I mean terrible. Suck. Yeah. So yesterday, September 21st, the Fed raised the interest rates another 0.75 of a point. That sucks.
Yep. Yeah, it's been painful.
Sucks for a lot of investments, doesn't it?
Yeah. Briefly, let's get into why that sucks. I mean, just as simple as you can. Why is the average cost of debt being more expensive hurt us right now? Why does it suck?
Hit it.
Well,
Brian.
it hurts us because we have to borrow at a higher rate. We still seem sellers still seem to be selling at the same cap rates. And so there's just not enough in between the cap rate and the borrowing rate to make much money.
100%. That's a perfect example. So at the beginning of the year, I think we were talking about this earlier, when we were buying Plaza West and some of the stuff in St. Louis, our cost of capital was sub 4, right around 4%. We were buying roughly 8 to 8.5 cap deals. That left us a 4 to 4.5% spread. Now the average cost of capital on that same deal, and it's not total cost of capital, average cost of the debt is probably low 6s, and you're still buying it on, like you said, probably a very similar cap rate. So your margin is cut in half on that deal.
Yeah.
So it's going to take a little bit for the sellers to soften the pricing and kind of get back going. You'll see a lot of stagnation, I think, in things trading.
Yeah, for sure. Sellers are not going to adjust their prices that quickly because, I mean, we are in a really hot economy, one that's in hyperinflation. That means a lot of money's out there. Yeah. And so that money needs to go into investments. People are selling. If they do sell to take advantage of high prices, they have to turn around and 1031 trade into another deal. And so the amount of money chasing deals hasn't gone down. It's still super high. What makes it so that's keeping sellers' prices low, but the debt picture for us, cash flow buyers, is really a challenging picture right now. And we're doing some new developments, and not only on the Criterion building, we have a floating interest rate.
Yep.
But also a lot of projects are going to stall because the debt coverage ratio is changing with the higher debt.
Oh yeah,
and it limits the amount of money that people can borrow against a certain project. And normally that would be fine because, rents are rising, values are increasing, but it's the speed at which the feds are changing or raising their rates.
Yeah.
If they're doing a quarter point every quarter, you may get a point in a year.
And that allows the sellers to adjust.
That allows
their
everybody to
time.
adjust a little bit better.
Yeah.
But real estate projects, especially developments, take 2 years to finish. And so when we're getting, was this the third 3/4 point or second?
Second.
I think it was a quarter, then a half, then 3/4, then 3/4.
Yeah, and they foreshadowed another half to 3/4 in November.
And so they're just changing it too fast for the market to adjust. And so we're gonna have a harder time finding the deals that cash flow the way we want them to in the short term.
Yeah, and it's also, I mean, it's not all doom and gloom, right? We're a week away from one of the best times of the year, and it's distribution time.
Yes.
So that's amazing because what have we seen in the market? I mean, market values have gone down. I mean, I think it's like 20% or a third of stocks on the New York Stock Exchange pay a dividend. That average dividend is like 3.5%. So not only is your value plummeted and you can't sell it, but your dividend is non-existent. And our value hasn't plummeted, right? Because we don't have to trade. We can wait this out, and we're still paying out double-digit cash-on-cash returns.
Yeah,
so it's times like these that people really appreciate the power of commercial real estate and want to get involved.
I can tell you, for my personal investments, I'm watching my stock value go down so much, and the real estate value I consider the same practically. I mean, maybe some of the values are dropping a little bit. There could be a case made for that, but we, like you said, we don't have to sell right now. We can wait until the market's better. So I don't consider that my real estate value has gone down, but my stocks are plummeting. The reason stocks go down, well, one reason, as they're raising interest rates, now the companies can't borrow to improve their assets and the amount of money that they're trying to make.
How's your crypto portfolio?
And crypto is
mine sucks.
It's the worst actually. Out of those three, real estate's okay, stocks are down, crypto tank.
Yeah, crypto's in the garbage. All right, so let's talk about what we're going to discuss today.
Yeah,
and it's a little bit of an abstract concept that I wanted to go over, and I'm going to call it expected value or implied value when making investment decisions. And we'll get into a little bit about what that means, but as you get into your real estate investing career, you're always going to be faced with, is this going to make money? How much money is it going to make? What are the risks? What is the downside? And sometimes you're not going to ever know exactly how an investment is going to perform.
Sure. Yep.
And so that's one of the things that I ran into early on. I was forced to make a decision. Do I want to buy this property? I think it can make money, but I also think I could lose money. How do you go about evaluating that decision? And it can't just be, I think it's going to do this. Like, you need some type of methodology that you're using, some logic and common sense to help, guide you in which, investments you should steer towards.
Yeah. If you have some numbers that you can stick by sort of with every investment, then investment after year, then more likely you're to succeed if you kind of have a feel for what it is that, the chances are.
Mm-hmm. Yeah, and you can't analyze an investment without looking at the full picture. And I think that's what we were talking about a little bit before the show is so many people just get hung up on the downside of, well, it could lose $500,000. Well, it's not a fair statement, because what if it could make $1 billion? That loss compared to the upside is nothing, right? It's a bet you would probably want to take.
And that hits at the core of what we're talking about today, because most people run from risk. And you can't get away from risk in this game.
Right.
And so what if I said that, kind of a thought experiment, that, hey, I got this investment for you. And you say, what is it? And it's like, well, it's a real estate. And then you ask me, is it going to make any money? I'm like, well, actually, it's going to lose money 80% of the time. 80% of these types of investment lose money. Mm-hmm. Are you going to take the deal? Most people are like, no, I'm never going to take that deal. It loses 80% of the time.
Yeah, there's no follow-up question after that.
But the thing is, you have to open your mind and you have to ask better questions, and you don't have enough information to decide if you're going to buy that deal or not. What if I said that this investment loses 80% of the time, and when it does lose, you're going to lose $100,000? Mm-hmm. Would you take it then?
Still only focused on the risk.
I still don't know.
Yeah, most people, though, are thinking, hell no, I'm not
Right.
taking that. It loses 80% of the time, and every time I lose $100,000. And so, but what if we told you when it hits, you're going to make $2 million? 80% of the time, you lose $100,000, and when it wins, you make $2 million.
Yeah. Well,
and you still may be asking yourself, I don't know if that makes sense. But we're going to break it down in a poker example, because I like to play no limit hold'em poker. And so if you have never played, this is not going to make a lot of sense to you.
So you specifically play no limit just because you're such a high bettor?
Well, no limit is that's what everybody plays now.
Big baller poker.
Yeah, no, it's just
all just stacks. It's
just
there's limit poker and there's no limit poker. No limit poker is that you can bet any amount of chips that are on the table at any given time.
Well, shows how much I know about poker already.
Yeah. So here we go.
We need to play poker sometime.
Yeah. This guy, we're going to play poker with him. Okay, so those of you that do know how to play poker, here we go. Let's say you have 4 to the flush, and you're waiting for the river to come out. Okay,
Which means you have 4 cards of the same suit.
I was lost in the first sentence.
Okay, so if you play no limit poker, we've had the flop and we've had the turn, and we're waiting for the 5th card that's going to come out on the table. I have 2 hold cards, okay, and let's say 2 of those are hearts, and 2 of the ones out here are hearts. So now I have 4.
4 hearts.
5 hearts makes a flush,
Right.
which is a really dominant hand and most likely a winning hand, especially if I have, let's say in my hand, the ace of hearts. Then it would be an unbeatable hand unless there's a pair on the board and someone can make a full house.
Yeah.
So how do we go about deciding whether we should call a bet on the river if I'm holding 4 to the flush? And so here we go. I'll try to explain this as easy as possible. In poker, there's 13 cards in every suit. There's 13 hearts. You didn't know that,
I
did
didn't
you?
know that. Yeah.
So I have 4 of them, 2 in my hand and 2 are showing on the board. So that means there's 9 out there left. So what that means is that there's 9 cards that can win me the hand.
Mm-hmm.
Now, there's 4 cards out here, and then I have the 2. So that's 6. You take 52 minus 6 is 46. Okay? Mm-hmm. That's how many cards are out there that I don't know what they are.
Mm-hmm.
9 of those make me a winner. So
we're just doing this live on the fly at the table.
I am doing it. Well, yeah,
you
this
can.
is how you play poker, if you didn't know.
So
9 times I'm going to win out of 46 cards.
Mm-hmm.
Okay. That is basically a 1 in 5 shot to win,
mm-hmm.
or 20%. I have a 20% chance of winning that hand.
Mm-hmm.
Okay. So let's say that there is $1,000 in the pot and someone bets $400.
Mm-hmm.
Okay. They bet $400. So now I have to call $400. And by calling 400, I have a chance to win the whole thing, which would be 1,800.
Yeah.
Okay. Because they bet 4, so it's 1,400, and I have to put another 400 in. It's $1,800. And you need to know, should I call that bet?
Mm-hmm.
Any guesses if I should call that bet?
Well, 800 to win 1,400.
You pay 400 to win 1,800.
Okay, 400 to win 1,800. And you have a 20% chance of winning.
Mm-hmm.
So yeah, I wouldn't do that because if you play out the odds, if you play it 5 times, right, you have a 20% chance of winning. If you play it 5 times, it's going to cost you $1,600, right, or $2,000.
Yeah, 2,000.
5 times 400, but you can only win 1,800.
That's right.
Okay, see, I just learned how to play poker.
Yeah.
There you go. And so that's a little bit of it. So let's say that someone bet $200 into the $1,000 pot. Or let's even make it easier. Let's say it's $100 bet into a $1,000 pot, and I have to pay $100 to win. So that means I bet $100 to win $1,200.
Yeah,
that's a bet I have to take.
Right, and what you have to keep in mind, I'm tracking better now. I'm glad I'm
feel,
glad I got the point of understanding while we're live.
You only have to play 12 times to get your money back, but the odds are 1 in 9, so the odds are
it's actually, I was wrong before. It's 20%. So you're going to win 1 out of every 5 times.
Yeah, okay.
And it's not a guarantee that if you play it 5 times, it's just the odds are you have a 20% chance.
You're playing math at that point, and you're saying over time, does it have an expected value or an implied value that's positive? Because you can have an implied value or an expected value that's negative. The more I play, if I call that $400 bet, we've already established that I'm going to pay $400 to try to win $800, but I'm only going to win 20% of the time. Over time, the more I place that bet, the more money I'm going to lose. Yeah. It's like gambling in Vegas. It's like playing roulette or whatever. Like the more you play roulette, the more you will lose.
Mm-hmm. See, and they do this at the roulette table too. They give you the odds on the screen, even though it's not relevant. Right, because you have the same odds every single time. It doesn't matter that 70% of the time it actually hit red.
Well,
it's the same odds of hitting red every single time.
Yeah, roulette is unique. Now they have 2 green spaces. Okay, and so if you put money on one number, or let's say you put it on red, and they're only going to pay you. There's 50% black and 50% red, and then the 2 green.
Yeah.
That 2 green is your expected value, and it's negative.
Yeah,
right. That's what's costing you, because they only pay out 1-to-1 on your bet. If you bet $100, you win $100, but you're not going to win half the time because there's 2 green spaces on there.
Right.
You're going to win 46% of the time or 44% of the time. So casinos, they don't really care if you win or lose. All they care about is the amount of money bet, because over time they just get a percentage of the money bet. But anyway, that's a little bit off the topic. So how do we take the poker example and we apply it to real life commercial real estate? Mm-hmm. There are deals, and I'll give you an example. One was an auction that we were bidding on an apartment complex in North Carolina. I had never been to the state of North Carolina, and I had to make the decision whether I was going to buy that property during the auction. And I had very little information to go by.
So right there, 99% of the people are out. Okay, never been to the state of North Carolina, tight timeline,
haven't seen the property,
and a difficult of understanding, getting all of the information and kind of gathering it. 99 out of 100 right there, gone.
Yeah.
Now, of course, I had some experience with apartments, and so I tried to use all of my experience in running B and C class apartments to come up with an expected value for the deal. Mm-hmm. And basically what I came out with is that the price was $30,000 a door approximately.
What year was this?
6 years ago.
16 maybe?
14, 15, 16.
Okay.
And so I tried to say, okay, if this investment really works and I'm able to turn it around and I'm able to fill it up, what's it worth? And I calculated that I could make potentially $2 or $3 million. And then I try to also ascertain if the deal doesn't work out the way I think it is. And I have to sell it. What is my potential loss? And these aren't exact numbers, but for me, I was trying to come up with that value. And I thought that, okay, 250 units, approximately, I thought my downside was $1 million, maybe $1.3 million, something like that, $4,000 to $5,000 a door if things didn't go well. And so in those moments, I'm trying to calculate expected value. I'm saying, okay, what's the likelihood that I'm going to make 3 million? What's the likelihood that I'm going to lose 1 million? Because both are real possibilities. And a lot of people get scared about losing the million, but they don't understand that the 3 million, how real that potential is. And so for me, I thought, well, I give myself a 50-50 shot here. I haven't been to North Carolina. And so I said, okay, I think it's probably 50% chance I make money and 50% chance I lose money. But for me,
but the 50% chance making was 3 million versus in your mind, the loss was $1 million at 50-50. So that means
you got to take the bet, even though you could lose $1 million. Mm-hmm. And a lot of people get frozen when they're evaluating commercial real estate because of the fear of losing. And the only reason we're talking about this exercise today is to help you guys understand how your mind needs to work in approaching investments. You need to try to evaluate your downside. Yep. You need to try to evaluate your upside, and then you try to put some type of odds on how likely it is that it goes well and how likely it is that it doesn't go well. Mm-hmm. And that allows you it'll give you the confidence to move ahead because you know that, well, that downside case might happen, but it's not likely to happen.
So in that specific example, I'm remembering now, the downside was the improvements. And the upside is, hey, if we spend this $1 million in improvements or $4,000 or $5,000, $6,000 a door, we should be able to get $20 a door in rent increases. And if we get $20 a door in rent increases and sell it on the exact same cap rate we bought it, that's $3 million.
Something like that. That's kind of how the exercise goes.
So it's not like we're pulling these numbers arbitrarily out of nowhere. You know, they're backed by something. But the thought was, hey, if I just put all brand new roofs, if I put all brand new windows, I could at least sell it for what I bought it for, minus the improvements. Mm-hmm. But the possibility of just getting a $20 rent bump,
or whatever, $50, whatever it was,
or whatever, could make millions.
Yeah. And so let's talk about another example. We do a lot of multi-tenant retail, and we have one center in South Tulsa, Village South, and it's got a huge gym. Mm-hmm. And that was the risk when we evaluated that deal is, okay, this deal looks great. We're going to make, $500,000 a year on this thing, cash flow. It's going to be awesome. But what if the gym leaves? And
first of all, if you're not asking that question, you're wrong.
Yeah.
You've got to ask the question. You've got to look at it.
And for me, I grew up next to the center. I used to drive by there. I knew that the gym was busy with people. And so I felt like the chances of that gym going out in the near future was 10%.
Yeah, maybe. I actually belong to that gym.
Yeah, I go there too. So
at the time.
And so if the gym moves out, it's going to hurt. That investment's not going to make money, and we may lose some money until we're able to fill it, which could be years. But if they do stay, which I give it 80-90% chance they stay, we're going to be making $500,000 a year. And so $500,000 a year under 90% of the circumstances versus maybe losing $1 million a year 10% of the time.
Mm-hmm. Where are these deals at now, man?
I know.
Can I get one of these sent over?
Hey, there's another example I'll tell everybody is we bought a deal in Vegas that had a big lots. It was in 35,000 square feet.
Oh, that's a good example.
This is a good example. And guess what? I did the same exercise. I said, they're probably not going to leave. This is going to make me several $100,000 a year. And I bet $3 million on it and bought it. Mm-hmm. And what did Big Lots do a year later? They moved out. And they've been out for the last 3 years. Mm. It's been vacant. And that's a $450,000 hit to the cash flow every year, right out of my pocket. Luckily, the rest of the property had leased up, and so I'm basically at break even. So even though I'm technically losing money by not having a tenant in there, I'm not actually having to come out of pocket with the $500,000. But that's an example of a deal that didn't go my way, as painful as that is. But the thing is,
nobody's going to buy it. Nobody's going to buy those centers that listens to this ever again, just because you said that.
Well, I think the important thing to know is you're going to play those odds, and you don't have to stress about, let's say Village South, the tenant did move out, even though it was a low chance. The next 8 centers you buy, they may not move out. Mm-hmm. It's a numbers game.
Yeah.
And so you can't worry about that one-off where you got bad luck and someone moved out. Don't let that stop you from taking a good bet. Mm-hmm. Just like in the poker example, you may call the bet of $100 or $200, whatever. And so there's going to be plenty of times that you make that bet and you don't get the hard on the river, and you're out that $100 or you're out that $200. That doesn't mean it was a bad bet. Mm-hmm. Professional poker players, they will take that bet every time and they won't think twice about losing that money. An amateur will make that bet. He'll get pissed off that he didn't get the heart. Right. And the next time it comes around, he'll be like, no, I'm not doing that.
And then you've ruined all your odds.
You've ruined your odds. And all because you're trying to avoid the risk of loss, not understanding implied odds or expected value. Mm-hmm. And I don't know that we've done a great job of explaining it today, but at least maybe it got your mind thinking that you need to think in terms of not this one investment, but how does this investment work if I had to buy it 10 times in a row? Mm-hmm. What is the expected value there? And that'll help give you the confidence on that first one to say, is this a good bet? Well, if I did it 10 times or 100 times and it came out with a positive expected value, then I should make the bet. I should buy the investment and not worry if, Big Lots moves out, because over time, enough of those deals, they're not going to move out. The likelihood that them all moving out is not going to happen, and you're going to be money ahead.
Yeah. Have you bought any more Big Lots deals yet?
No, I haven't. But we did buy in Slidell. They had some big tenants.
Yeah, they did.
But we like the traffic counts. We like the tenants. We didn't think they were going to move out. But there's a chance. There's a chance of them moving out.
Yeah.
And so many people in this game, we do it as human nature. We're always trying to avoid pain more than we're trying to get pleasure.
Same.
For the most part. And so people will be afraid to make what is a prudent investment decision to avoid loss or to avoid embarrassment or to avoid failure. And we're trying to tell you, hey, there's another way to look at that. Bring in all the information, look at multiple investments and how, tons of them will play out over time. And that'll help you make a decision today.
Mm-hmm. Well, I think that'll help. I mean, it certainly helped me not lose as much money on poker.
Yeah.
And make some better educated decisions. You've got to get out there and play the odds. And there's always a risk of failure. But if there's a greater overwhelming chance of you winning, that's probably a bet you should take, right? Mm-hmm. That's probably a deal you should look into. That's probably a deal you should buy or get some more data. And again, all of these numbers are pulled from something. They're not arbitrary numbers that we're just picking up. Oh, well, worst case scenario is I could probably lose $1 million. No, go in and ask yourself a question. What's the biggest risk facing that deal? And how much would that cost me? Okay, what's the best benefit this deal could have? How much does that make me? And start from there and hone it in, right? It's all educated assumptions. There's so many assumptions in real estate, and this is one of them.
And I'll remind people of a couple of things. First is you don't want to go into a deal, even if it's the expected value is positive, but you're going to lose $1 million and you can't stomach $1 million, like that'll wipe you out. You can't take that bet. Right. That's not a bet you can take. Someone else can take it, but you cannot take it. You have to be able to sustain whatever the odds say. Let's say you're going to lose 100,000 80% of the time. Well, you shouldn't take that bet unless you're able to lose $100,000 several times before you hit that $1 million winner.
Yeah, right.
That's number one. Number two, I want to remind everybody is this game, you have to get comfortable with being uncomfortable. There's so many assumptions. There's so much risk in every deal. And most of the time it's going to work out, but sometimes it doesn't. And you're never going to be able to just sit back and be comfortable. I made the best investment. Nothing's going to go wrong. This is all going to work out. That's never the case. And that's something I had to get comfortable with early on is I just felt at risk all the time. Yeah. I always felt like, what if this deal doesn't go? What if this tenant moves out? What if I miss something? that's the nature of this, is you have to get comfortable with being uncomfortable, with not knowing all the answers, and with taking risks and making bets.
Yep.
So,
well, that was a good one. That was a great
Aaron will have to edit all my wordiness, I think.
That's fine. Anyway, catch us next time on how to invest in commercial real estate. We will be back next week with another episode. Thanks, guys.
Thanks.